Welcome to Earth Archives. Today we are facing the AI wave. All financial media will say that this is the best investment, but history will tell you that this kind of thing has happened many times. Don't you believe it? Today I will talk about the railway bubble incident that you and I are all familiar with. Before the show starts, please subscribe, like, and turn on the little bell. If possible, leave your thoughts. This will help the growth of the show. Without further ado, let's officially start. While the heart-wrenching nightmare of the South China Sea bubble has not dissipated, people always heal their scars and forget about the pain. Less than 100 years had passed, and a new speculative game was before people again, the invention of the train. This greatest invention of the 19th century has also set off waves of investment booms and stock market bubbles. This phenomenon once again confirms the above rule, that is, investors firmly believe that this brand new means of transportation has the potential to endless economic value and development potential. Immediately, railway companies across Europe sprung up like mushrooms after a spring rain, and they went public one after another, selling stocks and bonds to the public in order to raise enough funds. Since only a few people were interested in investing in this emerging technology project at the beginning, the railway companies' stock sales were not expected to be high. According to historical records, in 1845 alone, 55 railway companies were listed on the same day. In order to lay 600 miles of iron rails, they raised £13 million of funds. As a result, by the end of 1845, the total sales of stocks and bonds of these railway companies reached 1.32 yen cake, which was an astronomical figure at the time. The total amount of various stocks and bonds issued by more and more newly listed companies continues to expand, and even India. The printing factory is almost unable to complete the printing tasks of all original bills. Since all the funds in the market were attracted to the stock market, the Bank of England was forced to double its deposit interest rate to attract depositors with an annual interest rate of 7%. This is often the case in financial history. When a new technology project begins to be put into large-scale production, funds in the market will be forced into the market at a so-called crazy speed, and then quickly hyped until the project is ruined. Usually, a concept is introduced to facilitate speculation, such as the creation of a new economic era, which makes investors and banking institutions unable to find a way out and can only throw a lot of money into the stock market. The indicators used to measure an investment project such as profit margin, cost control, and operation management are all left behind. Because of projects like this are said to be extremely profitable and guaranteed to make a profit in epoch-making new technology. In 1847, the first low point in this storm of hype came. Many speculators feel that their stocks have become a hot potato. On the London Stock Exchange, stocks in the railway company sector took the lead in falling, and their stock prices plummeted, causing many investors to lose their money. Most of them made a fundamental mistake, which was the so-called, putting all their eggs in one basket, that is, they bet all or most of their funds on railroad company stocks. At the same time, many banks, financial institutions and major bookmakers were also deeply trapped. What followed was a wave of corporate bankruptcies, including those of railway companies. Many companies are less than a year old and their capital is squandered. Management has no industry experience and can only watch the company collapse. There are also road sections contracted and operated by some companies that are not profitable at all, and the actual operating expenses far exceed the original budget. Compared with the speculative craze and stock market whirlwind in continental Europe, Americans on the other side of the ocean are even more enthusiastic about railroad betting. There, trains have become people's most ideal means of transportation. With the increase in immigrants from the New World, people have high requirements for goods, services and corresponding turnover logistics speed, raw materials, semi-finished products, etc. And they are full of expectations for efficient transportation. Due to the vast territory of the United States, there is a greater need for convenient and efficient long-distance transportation. Railway construction has become the locomotive of America's economic success. Renovation and expansion of existing road sections and efficient management of railway lines have become top priorities. The main problem faced by all parties is the shortage of funds, and the operating status of many road sections is that people cannot make ends meet. The extremely attractive Langyang industry and the current situation of companies in bankruptcy seem to be intertwined with each other. This kind of real and illusory state is exactly what speculators are looking forward to. In the mid-1850s, speculation in railroad stocks first appeared on the New York Stock Exchange on Wall Street. At that time, the US economy was extremely complicated. Against this background, people flocked to the stock market to buy stocks and bonds of railroad industry companies. More and more people are rushing in to get on the get-rich train. Just like in continental Europe 2 centuries ago, a local daily newspaper, the Little Herald, used the phrase, "get something for nothing, get rich overnight," to describe this speculative wave. Faced with the enthusiasm of many investors, those railway companies naturally wanted it. Company leaders, in particular, can easily raise sufficient funds, a large portion of which goes directly into their own pockets or is used to bribe local officials. There was very little money left to actually lay tracks and purchase trains. Railway operations were deteriorating, and derailments were reported frequently. What makes investors feel more reassured is that even many banks invest in the stock market legitimately and invest most of their idle funds in the stocks of the railway company sector. In this way, the bank's money is also invested in the general market with high risk. The entire national economy depends entirely on the prosperity and performance of the railway industry. Banks use a large amount of funds to purchase railway company stocks, and at the same time they also invest in speculative measures to encourage them to buy these stocks. At the same time, the railroad companies use the same method to issue corporate bonds to their customers in order to bundle more people's funds together. This is the form of risk aggregation often mentioned by experts. In 1857, what was to come finally arrived. Rumors circulated in the stock market that the Ohio Life Insurance and Trust Company was in financial trouble, mainly due to the complete failure of the company's stock investment in the railroad industry. One stone stirred up waves, and people didn't even have time to verify the authenticity of the news. They rushed to the bank counter to perform a run. Although the main task of a bank is to maintain the stability of the economic environment and financial markets, no bank can meet the withdrawal requirements of all depositors in such a short period of time, whether it is a long-term passbook or a current account. The bank had no choice but to close the counter window. Again, the price was announced. Frightened people immediately rushed to other financial institutions, and there were queues of people waiting to collect their gifts. Many banks could only urgently mobilize cash to make up for the lack of cash flow. People quickly lost confidence in the entire financial system. As a result, banks began to sell a large number of stocks in order to cash out as soon as possible. Large investors like banks smashed their stocks, causing stock prices to fall rapidly. What followed was a shrinking of investors' funds. What's even more frightening is that many of these investors rely on loan money to speculate in stocks. After the stock price fell to about 1/4 of the original price, the market value of the stocks in their hands was definitely not enough to repay the loan. As a result, many bank customers also went bankrupt, and their payments could not be recovered at all. Eventually, more than 500 companies announced closures, including many well-known financial institutions. 4 full years after the crisis, Wall Street stock markets are slowly recovering. It is gratifying that the stock market trading did not hinder the further development of railway transportation, and those invested funds were only in temporary difficulties. In 1850, the 50th anniversary of the birth of the train, the total length of railways around the world reached 40,000 kilometers. 30 years later, this number has grown to 380,000 kilometers.